All right, hello and welcome to this live edition of Capital Ideas TV. Our guest is Paul Beattie, co-founder of the Beatty Global Growth Fund, which he started in 2006. Paul is a value manager and he's got the 5 top picks for you today. He'll talk about his investing style and he'll take your questions as well. We're seeing some activity in the chat section of our YouTube channel. Now, while you're there, it'd be great if you could like our channel, like the show, the thumbs up. Share the videos with your friends, subscribe to our YouTube channel, and leave a comment after the show. And that would go a long way in creating some interest so we keep doing these live streams. Now, Paul's fund was up 11%, or is up 11% this year, was up 15.4% last year, and he's beaten the S&P TSX Composite on an annualized basis since inception with a return of about 9%. Now, before we get to Paul, we want to remind you that Capital Ideas produces a free daily morning note that you can receive to your inbox to get you ready for your investing day. All you have to do is go to capitalideasmedia.com to sign up for free. We also produce the weekly Capital Ideas Digest, where we curate investment ideas based on the research we pay for to arm you with the information you need to amplify your returns. We're offering a free 30-day trial right now to the Capital Ideas Digest. Go to capitalideasmedia.com, 30-day trial. Now on to Paul Beattie. First up, his bio board. Paul, as mentioned, is the co-founder of the BT Global Growth Fund. Prior to that, he was a partner at Stable Capital Advisors between 2000 and 2006. Before that, he was a vice president of investment banking at Merrill Lynch Canada, 86 to 91. And from an education standpoint, he got his MBA from INSEAD in France and his Bachelor of Commerce with honors from Queen's University. And here's Paul right here in front of us. How are you, sir?
I'm very well. Thanks for having me, Mark.
Very impressive resume.
I don't know about that. It's a long time ago.
That's
going
right.
to university, I can barely remember that far back.
Exactly, yeah. I'm sure it's a bit of a blur these days. But let's talk about your fund to start with. Some people may not know what it is. BT Global Growth, been around since '06. So give us an overview. What's the style? What's your overall mandate?
Yeah, Jacques Lacroix and I started the fund in '06. We kind of went with the premise that we like to be on both sides of the trade. We like to short stocks. We're long biased for sure. So we decided to design a fund that would be excellent for Canadian people, more conservative investors perhaps, that want to see long-term returns. We plan on beating the markets. We can do that through shorting stocks. We've done it many, many times. Remember back in '08 when everything was not going so well, we were net short the market, and we made money from the day Lehman Brothers went bankrupt every single month for 20 months. You can't do that without being net short. So we think it works. We think the Canadian market's not as efficient as maybe some other capital markets, particularly in the US. So we go long short, and we use no leverage. That's the other thing. We've restricted ourselves to not using leverage, which I think a lot of hedge funds do. So we don't leave the fund up.
Now, I mentioned the return. So far you're up about 11% this year. Last year, 15.4, which beat the TSX, which was down. And since inception, the BT Global Growth Fund is up on an annualized basis about 9%. So you gave us some of the ideas there as to how you do it. Can you give us some more flavor as to how you beat the markets?
Well, the one thing that shocks me in Canada, a lot of the advisors talk about hedge funds in a negative context. I mean, in New York City, if you're a high net worth person in New York, you may have 20-30% of your capital with hedge funds. I mean, the Americans seem to love it. Canadians seem very hesitant. Well, last year, every stock market I know of was down. A lot of them double digits, and we managed to make 15%. I mean, how are we taking high risks when you pull off something like that? We don't take high risks, or at least we try not to, right? That's the plan. So we're value people. We focus on cash flow. We're not experts in any particular industry, so I'm not going to tell you I know more about oil and gas or mining or banking, but we do invest in all these sectors. How do we do it? We focus in on, you've got 20 companies to choose from. which ones are the best value. We just focus in on cash flow. We're obsessed about cash flow generation, looking at the balance sheet, low debt levels, and then what is the enterprise value to cash flow. And if the multiple gets down to 3, 4, and 5, we buy. And if the multiple's at 6,500 times cash flow, maybe one could consider the thing as a good short opportunity.
So you've gone through a bit of your criteria there. So long, short, no leverage. You look at cash flow. You like to let your winners run.
Sure.
And that's a tricky thing for investors. Sometimes they know when they want to get in, but it's getting out. If they're up, they don't want to miss out on more upside. So how do you find that discipline to get out at the right time, or at least to scale out?
Right. I mean, I guess we love to find companies that we think will be successful for the next 20 years. That's our dream. And we'll trade around the position. I think we've made more mistakes selling winners far too early. So I think our view is, by the way, you don't pay tax if you don't sell, which kind of works as well. So I mean, the dream is to find a company trading at 4 times cash flow and growing at 20% a year with very little leverage. And 10 years from now, it's trading at 5 times cash flow, still growing at 20% with very little leverage. You think this doesn't happen? I can tell you, in the 13 years we've been investing, we must have 15 companies that have gone up more than 7-fold. We have 10 companies that have gone up more than 10-fold.
Give us some names.
Well, I'd like to say Air Canada. It's gone up 33-fold. We never owned it, but I mean that's a classic winner that we missed. Gildan was a big hit for us. Pacific Rubiales, patient home monitoring. I think we talked about that stock on BNN years ago.
And you got out in time?
We did.
Because that sort of imploded.
We made 15 times our money.
Wow.
And yeah, we didn't sell it all, but 15 times your money is plenty good, right? Drone Delivery Canada, we did more recently. A number of the cannabis names. I mean, I think there's some very exciting opportunities in the U.S. cannabis space. We fully intend to make multiples on our investment in that space. So that's what we look for.
Right, and that's one of your key themes in today's show, U.S. cannabis. We're going to get to some of the top picks from Paul in just a while. And some of them are in that area. Now, you also talk about certain things that people in the market don't really like to admit, and you've touched on it, but that there are those who say, based on studies and for other reasons, that the markets are efficient because all public information is in the market and in stocks, and so the markets are efficient. You're saying no, they're not, especially in Canada.
Yeah, it's unfortunate. It's not politically correct to say, but we have ample evidence that the Canadian stock market's not efficient. It just isn't, and I think it's better south of the border. Just more people, larger companies, more companies per industry. So more professional investors, bigger scale. I guess things do get more efficient. Here, you just have opportunities all the time. Even leaders in their sector may be mispriced for years. So anyway, we have plenty of evidence, and I've got some evidence today. We can talk about it.
Right. One of your top picks is in that area as well.
Sure.
That you think is improperly priced. So, being a hedge fund, and by the way, you manage a total of roughly 160 million, mostly high net worth money for people. Your main fund, you handle about 25 million.
25 million, that's right.
BT Global Growth.
Yep.
But being small and nimble, does that allow you to move in and out of positions and go short? Whereas larger institutions generally, they're too big to do it, and they probably don't want to do it either.
I think one of the sad realities is there are a lot of enormous players in our capital markets. I mean, the pension funds here in Canada are enormous. We've got multiple $100 billion plus pension funds. They are not going to be able to move. Even the Canadian market's not big enough for them. So we've got a lot of big banks. The banks have 85% of the investable private capital in Canada is in the banking system. So what's the point of shorting any stock, right? Go long everything and then take your money and invest it abroad. I think that's one of the problems in Canada. It'd be better if we had more smaller players, I guess. So yes, we're more nimble, for sure. We're more nimble. 25 million. We'd like to run it. We'd like to get it to 200 million. We run it as if it's a $200 million fund, but we'd like to get to that kind of level. I think once you get above $500 million, it's very difficult to run an efficient hedge product in Canada. So.
And what percentage of your positions in your fund are long, roughly?
Okay, so right now we're actually embarrassingly optimistic on the markets. So we're at 90% invested.
90, okay.
So we're fully invested for all intents and purposes, and then we have about 27% short right now. So we're long biased for sure. Normally we run at about 50 to 60% long, 20 to 40% short.
I see. All right. So we have 5 top picks here from Paul Beattie. He's the co-founder of the BT Global Growth Fund, which he's been telling you about. Now, first off, before we get to this first one, let's talk about your interest in the U.S. cannabis sector. We talked earlier, several weeks ago, probably in December, and you talked about that's one of your big themes for 2019. What is it about that landscape that you find interesting?
Well, it's, I mean, we've seen, everybody's heard about what's gone on, and if you've been observing the Canadian cannabis story, right, it's only a 3 or 4 year old investment opportunity. I think some stocks have done incredibly well. We were not in on the beginning, unfortunately, but we got in fairly early. We enjoy meeting and investing in the Canadian stories. But what's very clear to us is that this is sort of the rehearsal. The main show is going to happen south of the border. The American market, we think, is about $50 billion today. So $50 billion industry, let's make it simple. The market cap to cover a $50 billion revenue industry should be at minimum $150 billion. So 3 times sales. What is it now? If you add up all the US companies that are public, and most of the big guys have gone public, you put them all together and you look at their market cap, you're at 30 billion. 30 versus where it should be 150, there's plenty of growth. Now in Canada, it's not quite the same. In Canada, the market's only going to be 5, 6, 7 billion, and the market cap of a bunch of the players is north of 70 billion.
Right, it's kind of reversed, isn't it?
I think it's reversed. So, we're not going to spend a lot of time shorting the Canadian names because you never know what these things could do, and there's the whole global opportunity. But you are able to invest in US cannabis companies that are forced to list here in Canada, so you don't have to go far to check your stock price, and we get to meet with management and whatnot, and the market cap's 30 on its way to 150. There's plenty of opportunity.
So there are a handful of names that you like and that you own, but if you had the proverbial gun to your head, you say that the one you would buy is Green Thumb Industries, GTII. Now Beacon has a buy on this, target price of 44, which I believe gives it something like 160% upside, and they just closed a deal to buy Advanced Grow Lab. So why does this one stand out for you?
Well, we met with management when they did their RTO, came public here in Canada. They listed their shares. Very professional management, very ambitious guys out of Chicago. Incredibly professional, focused. We know them quite well. I can tell you they're working around the clock, building value for their shareholders. We think they're going to be one of the 5 biggest players. And by the way, the market cap is, let's be generous and call it 3 billion Canadian. So, 2.5 billion US. They're already in 10, 11 states. They do nothing but smart deals. They are going to be a player. And you can buy it at a market cap like this with opportunities in front of them. It's good value. I think they will succeed based on what they have now, and no leverage, lots of growth, and very, very competent management.
So we're looking at the chart here. You already got a triple out of it from less than 10 to 30, and then it settled back, but you still think it's undervalued?
Yeah, sure. It's settled back. It settled back as stocks all went down over that period. But meanwhile, they're building their business, and the company actually now at $18 is 3 times larger than it was back in July 2018. So it's a growth company. Where's this company going to be in 3 years? All I can tell you is they're going to be one of the 5 biggest players in America, and America's got a big market, so we like it.
All right, very good. So that is Green Thumb Industries, the GTII on the Canadian Securities Exchange. One of the top picks here from Paul Beattie. Let's move along to another one. This was a top pick last week from Bruce Campbell of Stonecastle Investment Management. It's Viamed Healthcare. Beacon has a buy on it, target price of $9.50, gives it roughly 60% upside. So this is all about, and by the way, this is a spin out from Patient Home.
That's right.
Speaking of Patient Home,
That's right.
as is ProTech, which you're going to talk about later as well. We have a question on that one. So yeah, Viomed Healthcare, they're in the homes with the COPD machines.
That's right. COPD is a nasty health issue in America. Pulmonary issues. In fact, I just heard the other day it's the third largest killer in America, right after heart disease and cancer. So these guys only focus on that. It's not the only thing they focus on, but they are number one at taking care of that issue. So they're still a small company. They're in 23 states or something, half the states. They'll be in over half the states by the end of this year. They have no debt, they're growing, and they provide services. They actually save Medicare and Medicaid money by keeping people out of the hospitals, which cost a fortune, and keeping them in their house, in their home. Look, everybody tells me, well, the stock was at $2 and now it's at $6, and therefore maybe I've missed it. I can tell you there's nothing that anybody has missed. The stock was mispriced at $2. I'm going to argue it's still mispriced today. They're going on NASDAQ. I mean, I don't understand. They made it fairly clear. They said, we're going to go list on NASDAQ. They've announced it. I think the Americans are going to come in and take a look at the stock. Has no debt. The cash flow multiple is insanely low. I think it's trading at 7 times cash flow, and it's growing at 30% a year. It should not be trading there. We can't find a healthcare service company anywhere in North America that trades at less than, let's call it 12 times cash flow. So they're going to list on NASDAQ. They've got a low multiple. They've got the growth. They're very good at what they do. I mean, I think it's just a question of how's the story going to get better known. So Bruce likes it. He likes it for good reason. Where's it going to go? I don't know, but double digits I think is a safe bet.
Yeah, you said possibly fourfold from here over the course of what, a couple of years?
Sure,
yeah.
Sure. Let's call it 3-4 years from now. But I don't think we have to wait that long to make returns, because I think the Americans are, it's going to list on NASDAQ. I mean, they've grown the business tremendously. They're now at that size where they can just squeak onto a bigger exchange. But I think the Americans are going to take it to 12 times cash flow. So you do the math and you get a higher number.
And the NASDAQ listing is when, a few months' time?
Yeah. I don't think you have to wait very long.
All right, interesting stuff. Viomed Healthcare. Now, we mentioned that Bruce Campbell from Stonecastle, who was on our show last week, also likes Viomed, also holds it. Let's have a listen and take a look at what Bruce Campbell had to say about Viomed Healthcare.
If we talk about kind of their secret sauce, this is what it is for Viomed, is that, there's other companies and other competitors out there, but typically they just sort of like give these people the ventilators and send them home from the hospital. And what they found is that these people tend to get readmitted back into the hospital, whereas Viomed, they have technologists that work specifically with those individual patients to show them and help them so that they continue to use the product properly, and so that their health actually stabilizes and improves, and they don't end up with those hospital readmissions. And so as a result, the Viomed tends to be, in the areas that they operate, tends to be the operator that the healthcare providers want to go with, because they know that they're not going to get any type of readmissions, and they get charged if they get readmissions. And so they really focus on sending those people to Viomed because their service is so much better. Now, what Viomed's doing is they've obviously started, in one geographic region. They just continue to expand out. So if you look at their growth, it's been tremendous. They, if you look just strictly at their revenue numbers actually, been stable and growing. It pulled back, but that was because there was actually a Medicaid and Medicare cut in the amount of reimbursement that they get for these. At the same time, they were able to increase enough of their organic growth with their patients that they basically kept year over year their revenue line almost flat. And now that cut's behind them, they can obviously go and continue to grow and increase their revenue. And they're also very profitable for the business segment that they're in. And so we think there's tons of room for them to continue to grow as they expand into other geographic regions.
Welcome back to our live show here on Capital Ideas TV. We're with Paul Beattie. He is the co-founder of the BT Global Growth Fund. Now, off the top of the show, in case you missed it, we want to reload a little bit here, and he's going to Just tell us about the fund in terms of the returns. Annualized since '06, up about 9%, beating the TSX. Last year, up 15.4%. And here's an example of that from your slide deck, your slide presentation. So I mean, had the year ended in, let's say, September, you were up about 40%. That's not reality, but you certainly outperformed. How'd you pull that off?
Well, we're sector specific. Some of our favorite, healthcare, the cannabis space, some non-bank financials, stock picking, basically. It's a stock picker's market these days. We think it's going to continue that way, and we're in the right sectors.
And then when it comes to picking those stocks, you have 6 main criteria. We've posted 4 here. You go long, short. A lot of funds don't do that. You use no leverage, unlike some other hedge funds. You really focus on cash flow, and especially buying stocks at certain levels of cash flow, 3 to 6 times, and let your winners run. So maybe expand on some of those thoughts.
Well, let's talk about cash flow multiples. I mean, why should Joe investor be able to go into buy a public company? The company's gone through all the trouble of going public, being listed, all that entails. Why should we be able to go buy that stock at 3 times cash flow? I mean, just think about that for a second. I mean, the private market values of just about every transaction's north of 6, 7, and certainly in the growth industries, into the teens times EBITDA. That's a norm in the U.S. Why are we able in Canada to buy companies at 3 times cash flow? So when you get these opportunities, I think you just need to get long, and then how do you offset that risk? Well, the best way we think is to find something that's trading at an infinite times multiple, and maybe has too much debt, and we frankly short it, and we'll stay long at the low cash flow multiple, because someday somebody's going to come along and say stocks shouldn't be trading this low, and we've got plenty of examples today. We're buying stocks all over the place at 4 times cash flow.
Mm-hmm. What was one of your best shorts since you've been in business?
Concordia Healthcare, the stock, we bought it at a very, very low cash flow multiple in January at $6 a share. By December, it was trading at 120. And,
so you ran it up and then you shorted it?
We got out in the 80s,
Okay.
and then Goldman Sachs got all excited about it, and the stock went to $124. It's trading at 70 times any futuristic cash flow, and we shorted the stock. We said it would go back to single digits within a year. It went to $1 within 8 months.
Yeah, that was an ugly story, sort of the mini Valiant. And actually, mea culpa, truth be told, the second Capital Ideas Digest that I worked on, we had quotes from 2 unnamed, we'll call them unnamed, to protect them, fund managers, and they said, oh no, they're in a bit of trouble, but we still like them, and that turned out to be one of our worst. It wasn't a recommendation necessarily, but we had it as a cover story, we thought, based on the recommendations of those 2 gentlemen, and that turned out to be incorrect. But anyway, so nicely done there. Now, also, let's hit home your point again about markets being inefficient, because there are a lot of people who say they're efficient, and you say that's not true, especially in Canada.
Yeah, I mean, I'm not sure why it's not that efficient, but I mean, even the index itself is not structured in a very intelligent way, right? I mean, the banks and the 2 insurance companies make up, 40% of the index. You've got a couple of utilities making up 10, or communication companies making up 10, 15. You've got energy taking up a big chunk, as high as 25%. I think it's lower now, but when the energy stocks are running, it grows to a quarter of our index. I'm not sure it's a very balanced index itself. I mean, I think healthcare should be at 10%, technology should be at 10%, and they're just not. So we've got lots of inefficiencies here. I think one of the other problems is that, big successful companies head south of the border, head to the U.S., benefit from terrific growth down there, and so we have a lot of orphan stocks up here. It's just the way it's been for the last 20 years, and I think that's the way it's going to be for a while. So these orphan stocks are kind of often mispriced.
In our chat today on the show, Travis R. has a question, 2 questions about Golden Leaf Holdings and 1933 Industries, TGIF. Unfortunately, Travis, thanks for the questions, but Paul doesn't cover those, but he does have a top pick coming in a while that is U.S.-centric, and it's a cannabis company. Speaking of top picks, let's get back to them, and we want to talk about Stelco. Speaking about inefficiencies in the market, here's a company that is public once again after having years and years of troubles. They came out with earnings today. You can speak to them better. They seem pretty solid. Special dividend they announced of $100 million, $1.13 a share, which is something that you were looking for. So what is it you like about Stelco, and why is the market not recognizing the value here?
Well, you know, here I'm going to read a quote to you. This is, I made a presentation just a while back, and I found this quote. I thought it was interesting enough to sort of talk about the inefficiencies of the Canadian market. Okay, so this is the CEO of Stelco speaking November 14th. So we take it back as the stock's declining every day. This is what he said in their earnings announcement. And I'm quoting, "Taking out our 2 last quarters of adjusted EBITDA on an annualized basis, we're trading at a very low 1.9 times EBITDA multiple." Okay, this is him telling us. "A huge discount to our peers, which trade between 4 and 6. This multiple doesn't take into account any value for the real estate or the fact that we have cash, we have no debt, unlike any of our peers, or that we have the highest adjusted EBITDA margin in North America, both on the most recent quarter, trailing 6 months, and trailing 12 months basis, and significant organic growth opportunities, or the strong balance sheet and management track record experience in building value." So this guy in one paragraph tells you that his stock is ridiculously cheap, 1.9 times. Now, that was November 14th. What happened to the stock since then? Well, it continued to go down. I don't know what cash flow multiple he actually got down to, but I'm going to tell you that this is not a small company. This is a $1.5 billion company. The stock's trading at a ridiculously cheap multiple, so we bought. Yeah, they announced their earnings last night. Their earnings are even better than this. I don't know what the multiple, because the stock's gone off the bottom, but the stock is ridiculously cheap. The balance sheet's strong. They actually announced a special dividend. So if you own Stelco stock as a Canadian citizen, you're actually going to make 10% on your dividend in the last, now. And by the way, they did the same thing last year. So I'm getting paid 10% to own a non-levered, highly competitive, market leader in that's trading at a ridiculously low multiple. That shouldn't happen, and it does. And they only trade in the Canadian Stock Exchange. So I mean, what? I guess I think it's proof positive. By the way, buy the stock. It's one of our biggest holdings, and I just think the multiples are too low.
Now this chart we put together after the close yesterday, so it doesn't reflect what I think is about an 8% rise today.
Sure. After
the earnings came out, and you make a good point. There's the special dividend of, what do we say, $100 million, $13 a share. That's on top of the regular dividend. Do they pay quarterly or monthly?
They pay a quarterly dividend.
Quarterly, okay. Yeah. All right, very good. A little dissertation there on Stelco. Another top pick is Go Easy. We've interviewed the CEO here before, David Ingram, more than a year ago. They had record earnings recently, and just a bit of analyst commentary here. Cormark raised the earnings per share and revenue estimates. Raymond James kept their outperform and $58 target. BMO took the target down to 55 from 60, but kept the outperform. And I'm kicking myself for not putting together a longer term chart, because this has really been an incredibly successful story year after year after year.
They've actually met their numbers for 19 straight years. They've been public for 19 years. They always meet their guidance. I mean, it's a tremendous success story. We like it now. We've owned it for years, probably 10 years now plus. We actually like it more now than ever. So the stock, I'm not sure why. The stock got up to $50. It went up quickly, got up to $52. It came down last fall. I would argue that it should never have come down this much. By the way, they've done nothing but meet all their guidance. The numbers are very good. The stock got down to as low as 7 times earnings. I think even lower, maybe 6.5 times earnings. They pay a dividend. Nice dividend. They have leverage. They're a finance company. They do have leverage, but they're less levered than the Royal Bank. I can tell you that. They also have a higher ROE than the Royal Bank. They basically take care of Canadians that want to borrow money, but that the banks don't touch. Right? The banks don't lend money to their clients, so they charge higher rates. But they do a great job. They've been around for a long time. I think it's a growth company. The company grew 30+% last year. They've guided to higher 30% type growth this year. By the way, they give 3-year guidance. I mean, I think it's terrific. They map out what they're going to do for shareholders. If you believe their numbers, the stock is going higher. We think the stock should be way north of $50, where it was. We didn't sell a single share at $50. We're buyers here. What's not to like about the company? I think you're right. You quoted all these companies, the firms that are covering them. There aren't that many that are actually covering them. I think you quoted basically all of them. They all have targets significantly above where the stock is. The stock has had a nice little rally in the last few weeks, but my own personal target would be $80. Let's call it 2 years from now. 2.5, 3 years out. Given their guidance, the stock's going to be $80 and maybe higher. So
interesting.
Yeah.
All right, very good. So that's Go Easy. That is another top pick of Paul Beattie. Let's get to some questions here. We had one through Twitter on ProTech Home Medical, PTQ.
Sure.
And I believe they raised $13 million a little while ago. So here's another spin out from Patient Home that that you like as well.
Yeah, they were in to see us just last week in Montreal. They come up to Toronto, do a pan-Canadian tour to meet with their shareholders. It's a lot of work for them. It's a U.S.-based company, right? U.S. focused. They're very busy building their business. Business is very good. Very little debt, and in this case they have some debt, which by the way just got refinanced last week, so I can tell you exactly. They have $13 million in debt, convertible debenture that the Beacon guys just raised for them. So they have some convertible debt, nothing else. They're growing at 30% a year. They have cash flow multiple, we think it's as low as 4. And they're in the healthcare space. As I said, the healthcare stock shouldn't trade at 4 times. I mean, they should minimum trade, let's call it 10, right? Double-digit multiple. Business is good. They're for these guys. They when PHM bought the company, when was it? That's probably 6 years ago or so. They had 10 million in revenue. We think they're going to do 80 this year. So, and that's all organic. Well, I wouldn't say all organic, but mostly organic. Now they have cash on the balance sheet with this new debenture. They raised a little more than they need. They're going to go do acquisitions. I would expect the company to go through $100 million in revenue this year, up from 6 years ago. It's a growth story, and competent management, focused, incredibly cheap. You find us a cheaper healthcare multiple, please do. We'll buy that one as well. We can't find one, and we've looked. We spent a lot of time looking. We love the healthcare space. What's not to like? And they changed the symbol. They consolidated their stock. Changing the symbol from PHM was a smart idea, and consolidating the stock, I think, was a smart idea as well. Who cares how much volume a stock trades? What we care about is value, and the stock's heading higher.
What was the split that they did?
I think they did 5 for 1.
5 for 1. Okay.
Yeah. So they took it back up, above $1. I think the stock's around 80 cents right now. It's had a good run. Well, of course it had a good run. It was trading at 3 times.
We don't want to look at that one. That's something different.
Oh, there we go.
Okay.
It's a similar chart, though, right?
Yeah,
there you go. Right,
yeah,
there you go.
Yeah.
So it's gone from 50 cents to $1. It's a quick move, but at 56 cents. That was after the consolidation. The stock should never be trading. That's 3 times cash flow. It just shouldn't be there. So I'm not sure I read much into the historical chart. Like if a stock's doubled, does it mean it's not a good opportunity anymore? In this case, I just don't believe that at all. I mean, what is the cash flow multiple today? How is business? I think you've heard that stat, 10,000 Americans are turning 65 every day. Well, those are all potential clients for this company.
Right. All right, ProTech Home Medical, PTQ, on the venture. That's another idea there, a bonus idea based on a question from one of our viewers. Speaking of bonus ideas, how about Cannabis Capital? Here's a company that Bruce Campbell talked about last week, and we'll hear from him in just a moment. But so Cannabis had that deal in the U.S. that they apparently, Bruce says, they backed away from. Now they have another deal. They got a cash injection. So where do we stand now with Cannabis Capital?
So they have merged with a company that's going to be 4 times their size. So in fact, it's really like an American cannabis company doing an RTO on a Canadian public company. So it's a large company, 4 states merging with Canex, which is in 1. So it's going to be a 5-state operator. I believe they're going to make money, right? Unlike a lot of the Canadian guys, these boys are already profitable, growth-oriented. As I said, south of the border is where the size of the market is. I think, well, what's going to happen is it's going to be approved. That's going to take a few weeks, months. So let's call it 8 weeks from now. You're going to have this company trading at about a $500–600 million market cap in 5 or 6 states with no debt and growth in front of them. And we think relatively it looks very cheap, and I think it's going to be a growth company with very smart management. They also have the backing of some very sophisticated money in New York and California. So, smart finance guys have chosen this vehicle to endorse and to back. And I think they've done it with. I think they've backed Dianthus and others, and those stocks have done well. We believe Canex is going to do very well. We think it's good value.
Okay, so that's your take on Canex Capital. Let's hear from Bruce Campbell, who was on last week. This was one of his picks. So why does he like Canex? And part of the reason, as you'll hear here, he likes the fact that management was disciplined in not executing that deal that they just didn't like for whatever reason and moved on to find something else.
I always love it when a management team backs away from a deal. And that's exactly what they did, is they went down into California, they started doing their due diligence, and obviously either the terms weren't right or they got spooked by something they saw, and they backed away. And the market, of course, was disappointed with this. They were looking forward to having this acquisition done, and so the stock price pulled back. In the meantime, the team was out there looking for other opportunities, and they came across this opportunity with Forefront. And Forefront is a cultivator in sort of the Midwest and eastern part of the U.S. They have real focus on the West Coast with Northwest Cannabis out of Washington, and the two are going to combine. And at the same time, they also got a huge cash injection by equity investment from Gotham Green. And so you sort of combine that all together, and once this deal closes, which the market's probably not really paying up for it yet, because they probably look at it and say, oh, well, Canex had trouble closing before, which I don't really think they had trouble closing. They chose not to close it. But once they close this deal, then I think the stock gets revalued and goes significantly higher. Because again, if you sort of look at it from the multi-state operator perspective, it's fairly cheap compared to most of the multi-state operators that are out there now from a valuation perspective. And once they do this, they'll probably bring their expertise from the West Coast to the East Coast and vice versa. And so they're going to get a lot of efficiencies. And then they probably also open themselves up to make more acquisitions.
Kintavar is a unique exploration company that looks at undervalued and underexplored projects and converts them into what today is a Michi stratiform copper project, a unique stratiform copper project in Quebec. It's the only primary copper exploration project in Quebec. Strong support from the local community, great access to infrastructure, great location, camp, power, everything is accessible. And we had a great year in 2018 demonstrating the size of the project, and we expect 2019 to be even a better year than what we had in 2018.
We are back with Paul Beattie, the co-founder of the BT Global Growth Fund. We're taking some questions from viewers. We have Mike Zed in the chat, and he wants your thoughts on a couple of cannabis companies that are U.S.-centric. Curaleaf, which went public a few months ago, and it was one of the bigger IPOs, I guess it was. So Cura, which is on the Canadian Securities Exchange. Tell us about Curaleaf.
So it's one of the bigger players. I think they're second or third largest. They may be second. So they had not a great debut, right? I mean, I guess they raised a little bit too much money, and maybe the valuation was a little higher than warranted.
But they raised about $400 million.
That's right, yeah. Big money. They're a big player, very legit, very capable. For sure, they're going to be one of the 5 winners. So I have no problem. We own it in the fund. I own it personally. I think it's a great investment. They're very competent. Valuation is not small, but they're well established already good growth companies.
So these big American cannabis companies, are they all pretty well multi-state operators,
Sure.
and that's the appeal?
Sure. I mean, you could just be in California, and I'm sure you can build a big business. But the smart money would say, let's get into New York, Florida, Massachusetts. We think it's going to be a big market, and of course California, Nevada is going to be a big market. So why not be? You can only be in each state operationally, but so what? Get into all these states. And I'm not sure how many cures in front of, but I think they're over 12 now.
Okay, and then Mike Zed also asked about, let you take a drink of water there, he also asked about Charlotte's Web, which, if memory serves, also went public fairly recently.
That's right, yeah. And Charlotte's Web had a great debut. We bought in on the IPO round. It's a big holding for us today. They're focused not on cannabis, but CBD. They're in fact the most well-known CBD company, well, probably in the world. The famous story of taking care of Charlotte. They named the company after this young girl who was suffering, from epilepsy, and no longer suffers nearly as much. It's really quite impressive. So terrific company. They are going nationwide, right? With the passing of the Farm Bill in early December, allows them to go to expand, in all 51 states at the same time, 50 states at the same time. And we think they're going to do big deals with big retailers. They've got actually 4 different verticals, including even taking care of your pets, right? CBD for pets. I'm not sure how nutraceuticals, pharmaceutical, and health products. And I think they're going to be. It's about a $2 billion market cap, so it's not a small company anymore. But you're number one at what you do in America in a big market. We think the CBD market could be as big as $50 billion in a few years. So it's a big opportunity, and they're a very impressive company.
So Charlotte's Web is the largest in terms of producing CBD-based products.
That's right.
Do they do the extraction as well?
I think so. Yeah. Mm-hmm. Yes. They're the and they've got the brand. I mean, people know what Charlotte's Web is, and they know about their products, which I don't think, many other customers know any other CBD player, right? So they've got that brand, and very good management. I mean, we're impressed. When they came in and told us we're going public, we're going to do this, and this, watch us. They've done it all.
And they've executed.
Yes.
All right, thanks for that, Mike Zed. Curaleaf and Charlotte's Web. Those are the answers from Paul Beattie. Now, still with cannabis, still with the U.S. So how about the last top pick here from Paul, and it's Planet 13. This is a company we've interviewed before. I just realized I'm really shiny. I didn't put any makeup on today. We were having such a good chat before the show. Anyway, whatever. This is me without makeup. All right, so Planet 13, they've opened up this big dispensary off the Vegas Strip. They're planning a cannabis entertainment complex in the same area. So tell us about Planet 13, what you like and what kind of growth we're expecting.
Yeah, it's a simple story, right? I mean, they've built I think it's the largest dispensary in America. It's just off the Strip. I mean, it's not far off the Strip, right? It's 700 paces from the Wynn Hotel. We like the management, professional guys in other businesses other than dispensing cannabis products, right? They're very serious business folks. They built an attractive venue. They're getting about 1,800 people per day. I mean, you need to imagine that. That's a lot of people. They're spending about low 80s per day. So this is a good-sized business. They have 43 cash registers. Imagine.
Yeah, and that's a fair-sized basket, as they like to call it in the retail. You're walking out with an average of $80. That's quite a bit.
That's right, and basically thousands of people coming. I'm not sure they're keeping track of who spends the money, but I think people, thousands of people per day are coming to their store. It's all very well done. I think the big upside. Well, first of all, the stock's not that expensive. It's a couple $100 million Canadian. So let's call it a couple $100 million US. But you've built the thing, you have the license, you're up and running. Everybody's going to want to be in your store, right? Everybody who's got a CBD product or some cannabis vape pen or whatever, they're all going to want to be in that store. They're going to pay to get on those shelves. Vegas has 40 million people. Like we changed our focus and our view entirely, because Vegas is not that large a town or whatever. New York City is going to be better than Vegas. But if you really think about it, 40, 50 million people showing up in your town, you're going to sell a lot of products if you're on the Strip. And so the market cap's only a couple of $100 million. What's the future? Well, I think they're going to apply. Right now, it's not legal to actually consume cannabis anywhere in Las Vegas. So those 50 million people that want to consume are actually breaking some kind of law. I don't think the city likes that. So I think the city's going to say, hey, why don't we have some lounges where people can consume the product? If they give out lounge licenses, I think it's Planet 13 is going to get one. If they get one, it's going to be a big additional boost to their already interesting business. So I think they're going to trade for half their revenue, which really can't last for very long. So I think the stock's got a great future. Now you may have to be patient. Maybe you have to wait a year. Well, okay. But anyway, great management. They own half the company. And I think I think people would like to buy that. All these other big players are going to want to buy, the largest dispensary in America. So right. I think it's I'm not sure what the downside is. I mean, the stock's been beaten up a bit, and is it going to go any lower? I'm not so sure. I think we're probably there, and let's just wait a year, see where we're at.
Okay, very good. So that's Planet 13, another top pick from Paul Beattie. Let's recap his top picks today. Green Thumb Industries, GTII. Viamed Healthcare, that's VMD on the TSX. Then we move along to Stelco, STLC in Toronto. Go Easy is another top pick on the TSX, the GSY. And then I mentioned Planet 13, PLTH on the CSC. And I should mention that Capital Ideas provides some marketing services to Planet 13. In fact, we are busy producing an advertisement for them that's going to run on BNN Bloomberg. And who else should I disclose here? I guess that's it. Yeah. So, great show.
Thank you, Mark.
That's 50 minutes, just like that. And hope you enjoyed that. We really enjoyed all the insight and information and all the picks, and we'll do it again.
Thanks for having me.
All right, great stuff. Thanks, Paul.
Cheers.
Thanks a lot for watching. As we wrap up this show, a reminder of the special offer from Capital Ideas, a 30-day trial. This gives you immediate access to our premium weekly digest. These are the research-based, actionable investment ideas that we reserve for our paying subscribers. You'll get access to 4 issues and our complete archive, and you can find out what you're missing out on. Just go to capitalideasmedia.com, 30-day trial. Now, if you missed any part of the show, you can watch it on our website, on our Capital Ideas YouTube channel, which you're watching right now. And while you're there, right now, if you could like the show with the thumbs up, share videos with your friends, subscribe to our channel, leave a comment after the show, and that will help create some more interest in our live streams. We've got a podcast version of this show coming next week. We just posted today our podcast version of the Bruce Campbell Show. So if you want to listen to that, if you prefer the audio than watching, you can do that. Thanks again, and we'll see you next time. Take care.